I made $10,000 trading this one simple strategy, and it completely changed my trading career. For more than 3 years, I was stuck in a cycle of losses. I tried different indicators, different strategies, and watched countless trading videos, but nothing seemed to work consistently. My trading account kept going down, and honestly, it started affecting my confidence and even my personal life. At one point, I genuinely felt like trading just wasn't meant for me. But then I discovered something that completely changed everything. I realized that profitable traders don't overcomplicate trading. They focus on simple rules, patience, and the right timing. Once I started following this one strategy consistently and sticking to a few simple rules, things began to change. Within 6 months, my trading improved dramatically, and eventually, this strategy helped me generate over $10,000 in profit. And the crazy part is, it's actually very simple. In this video, I'm going to break down the exact strategy step by step, so you can understand how it works and how you can apply it in your own trading. The first step of this strategy is understanding the weekly direction of the market. To do this, we look at the daily time frame. The daily chart helps us understand the bigger picture of what the market is doing. Ask yourself simple questions. Is the market making higher highs and higher lows? Is it making lower highs and lower lows? Or is the market moving sideways? If the market is making higher highs, the bias for the week is likely bullish. If the market is making lower lows, the bias is likely bearish. This step is extremely important because it gives you direction. Instead of trading randomly, you now have a clear idea of where the market might go during the week. And remember, trading with the overall direction increases your probability of success. Once you have the weekly direction, the next step is to determine the daily bias. For this step, we move to the 4-hour time frame. The 4-hour chart helps us understand what the market is doing within the week. Again, ask yourself, is the market trending up? Is it trending down? Or is it consolidating? If the market is moving upward, then we focus on buying opportunities. If the market is moving downward, then we focus on selling opportunities. But if the market is moving sideways and consolidating, the best decision is often not to trade at all. One of the biggest mistakes traders make is forcing trades in bad market conditions. Sometimes the best trade is simply no trade. Now this is where timing becomes very important. Instead of trading the entire day, this strategy focuses on a specific time window. The best time to look for entries is between 8:30 a.m. and 10 a.m. New York time. Why this time? Because this is when the New York session becomes active, and the market often experiences increased volatility and strong moves. During this time, large institutions and professional traders are actively participating in the market. That's why many significant moves begin during this session. By focusing on this time window, we avoid random market movements and instead trade when liquidity and volume are higher. Once the New York session begins, we start looking for entry zones. These zones can include things like order blocks, buy zones, sell zones, areas where price previously reacted. If the market bias is bullish, we look for buy zones. If the market bias is bearish, we look for sell zones. The key idea here is to wait patiently for price to return to these areas. Many beginners make the mistake of chasing the market, but experienced traders usually wait for price to come to them. So when price enters one of these zones during the New York session, that's when we start looking for a potential entry. Once price reaches your zone, you can look for confirmation and enter the trade. For example, if the market bias is bullish and price reaches a buy zone, you look for signs that buyers are stepping in. At that point, you can enter a buy trade. If the market bias is bearish and price reaches a sell zone, you can enter a sell trade. The important thing is to follow your rules consistently and avoid emotional decisions. Discipline is what separates profitable traders from losing traders. For targets, this strategy keeps things very simple. Your target can be previous session high, previous session low, the current day's high or low. For example, if you enter a buy trade,
your target could be the previous session high or the current day's high. If you enter a sell trade, your target could be the previous session low or the current day's low. These levels often act as natural price targets because many traders watch them.
This is one of the most important parts of the strategy. If the market is consolidating, the best decision is to stay out of the market. Trading in consolidation often leads to false breakouts, stop losses, unnecessary losses. Professional traders understand that not every day is a trading day. Sometimes waiting for the right setup is the most profitable decision you can make. This strategy may look simple, but simplicity is often the key to consistency. Remember these main rules. Determine the weekly bias using the daily chart. Identify the daily direction using the 4-hour chart. Focus on the New York session between 8:30 and 10 a.m. Wait for price to reach key zones. Target previous highs or lows. And most importantly, be consistent. This strategy changed my trading because I stopped overcomplicating everything and started following a clear set of rules. If you want more content like this, where we teach markets in an easy and simple way, breaking down exactly the way professionals sees it, make sure to follow the Insider FX.